The advantage with commodities over purely financialized asset classes is that they have an element of tangibility to them. So it's human nature to want a tangible asset. So that is why we see the psyche of humans, and especially us Indians, is that we want asset classes that we can touch, feel, and see. So, for example, gold, real estate. That's why the Indian love for gold and real estate is so high. The advantage with commodities now, vis-a-vis in the past, is that earlier, if you say bought 10 tons 10 tons of a commodity, the truckload would come at your doorstep. Now, the commodity will go in the warehouse. A warehouse receipt will be issued. That physical receipt would be dematerialized and financialized. You will be able to buy. Please mute your microphones, everyone, please. So, as an investor, you will be able to buy. I'm requesting all the participants to kindly mute the microphones. So as an investor, you would be able to buy a financialized asset with an underlying tangible asset. Whereas in equities or bonds, you ideally the certificate is destroyed and only the dematerialized retained. So commodities will give you the best of both worlds in terms of tangibility as well as financialization of the asset class. Another great advantage of commodities is that they have a huge negative correlation to equities and bonds most of the time, and especially this is true over longer holding periods. Now, when there are periods of inflation, commodities do exceptionally well, and at that time, normally stocks and bonds don't do so. It helps in portfolio diversification. So every investor would want to have a diversified portfolio. Like, for example, you would not like to eat only one item for your lunch. You would like to eat a thali. So you have various vegetables, you have dal, chapati, and whatnot. So similarly, in a portfolio also, you would like to have more and more asset classes, because having more asset classes in a portfolio helps in diversification of the portfolio and reduces the standard deviation or the risk of the portfolio. Commodities are also a natural hedge against inflation. So we find soft and perishable commodities like agricultural products and hard and durable commodities like metals. And commodities are the raw material for economic activity. So nations have been built and wars fought on commodities. They touch our daily lives. Whatever the clothes you're wearing, the food you're eating, the house you are living in. I can't say much about cars because we've hardly traveled in our cars of late, but it touches our daily lives and everything we see around us. And because of that, commodities are very intrinsically linked to our daily lives. Now, in terms of participation in the commodity derivative markets across the world, globally, there's among all the asset classes, commodity derivatives form 24% of the derivatives markets, whereas India, it's just around 3%. So we have a long way to go in terms of commodities expanding in India. Now, the value proposition to investors from commodities is, of course, diversification and asset inflation protection. Also, you can take a positional view on commodities depending on the view you have. Also, the advantage in commodity markets is, unlike other financial markets, is that there are not only investors in these markets, but actual end users like farmers, hedgers, producers, consumers. So the ecosystem is very large and very well diversified. So that is why one should also look at commodities in your asset, in your portfolio. In India, between 2016 and March 2020, the correlation between the MCX iComdex index, the composite index, and the NSE's Nifty was only 15%, which shows that, which highlights the point I made, is that commodities have an inverse correlation or a very low positive correlation with equities and bonds. Also, many people say that, well, I could invest in equities of companies handling commodities. But normally we have seen that the correlation of the stock price of that company dealing in commodities is not so much with the commodity itself. For example, the correlation of the shares of a gold mining company would not be as similar to what gold would return. It would be only around 55-60%. So How do you invest in commodities? You can invest in commodities through the derivatives contracts, the futures and options on the regulated exchanges. You could approach commodity markets through mutual funds, through portfolio management schemes, through category 3 AIFs, indices, which we are planning to launch very soon, or through ETFs or through mutual funds. Since today the topic is mutual funds, we will dwell more on mutual funds and how they can help in diversifying our portfolio and how it can help investors approach the commodity markets. So with this, I'd like to throw open the panel discussion, and I have a very eminent panel with me. I have Mr. Anil Ghelani of DSP. I have Mr. Vikram Dhawan from Nippon, and I have Mr. Aurobindo Gayan from Tata. So welcome, gentlemen. It's indeed a pleasure to have all of you here, and thank you for accepting our invite and being with us here today. The first question I want to ask to all the panelists one by one, and I'll start with Anil, you first, is that why should one invest in commodities? Anil, you're on mute. Can you unmute yourself? Yes.
Yes, hi, good evening, everyone. Rishi, that was a very perfect question. And in fact, thank you very much for already setting up the backdrop for giving a good response to that. I believe very strongly
Anil, your voice is breaking up. Anil, sorry to interrupt you. Your voice was breaking up. Can you just go back and start again, please?
Okay. Sure.
Or maybe if you switch off your video, then your audio will be.
Sure. I'll try. Yeah.
Your voice is breaking up, Anil. So if you could just switch off your video while you're speaking, and then maybe your bandwidth will get better.
Yeah, that's right. So I just switched off my video. I hope I'm more audible better now.
Yes, yes.
Sure. So I believe very strongly that for any investor's portfolio, a holistic asset allocation approach should be followed. So if we try to split apart, one is the component which is asset growth. For that, we have the standard traditional asset classes like equity, bonds, private capital, private equity, etc. Second part, we have income generation. For that, we have government bonds, corporate bonds, rental property, etc., which is for income generation. The third component is a kind of an inflation hedge. For that piece, one needs to have things like commodities, real assets, or in certain countries where possible, inflation-linked bonds. And the fourth piece to complete the circle is a volatility management where you need to just hold some kind of a cash, maybe to send to either cash funds, money market funds, liquid funds, arbitrage funds, that type of approach. So in this holistic approach of the asset allocation, where this third piece, so after you have created asset base through the equity, bonds, etc., created income generation through the other piece, then this third piece becomes very crucial, where you need to have an inflation hedge, in which case commodities form a very important part of your portfolio allocation. So in my view, Rishi, adding on to the initial backdrop you set up, having commodities as a part of your overall asset allocation is very, very important. And how much percent of definitely it's a must have in any investor's asset allocation portfolio.
Thank you, Anil. Now coming to you, Vikram, would you want to add to this and any other opening statements you would like to make?
Sure. I think I hope I'm audible, Rishi.
Yes, yes, loud and clear.
All right. Okay. So yes, Anil has actually articulated it pretty well. But a few things I would like to add. See, the questions which investors and fund managers ask when you are, trying to discuss commodities is that, why should we invest in commodities? I mean, my answer is very clear: to make money. But then the second question comes is that, you have equities which give you dividends and capital appreciation. You have bonds which give you coupons and the duration also. What do commodities have? Why one should even look at commodities? Whilst commodities will not pay you any coupon, they will not pay you any dividends. They are cyclical in nature, and whatever you might lose on the bonds, on the coupon and the dividend and everything, is more than compensated by the price moves. Um, Commodities, the cyclical nature of commodities is the attribute why investors should invest. Obviously, at the end of the day, every investor wants to make money. There is portfolio diversification, there is hedging, everything is involved. But at the end of the day, we want our wealth to grow. Also, there are many questions, but the time remaining, I'll probably try to ask and answer a few on my own to the best of my whatever little I know about the commodity markets. The other issue with the investors and fund managers is that equities have a balance sheet and a P&L account. Bonds have rating, whether it is a S&P rating or a Moody's rating or a CRISIL rating, it is a rating. How do you rate the commodities? Whilst it may not be apparent that commodities have a balance sheet or a rating, but just to throw a few examples, there is something known as the demand supply of each commodity. There is something known as the price of production of each commodity. There is something known as the volatility, the past returns, the correlations. So there are, whilst it may not have a comprehensive balance sheet or a rating at one place, uh, I would really request if you can mute it, please. It's coming. So whilst commodities will not have a comprehensive balance sheet or a rating by an S&P or a CRISIL, but there are various factors which you need to appreciate before you get into commodities. Now, whether it is commodities, whether it is equities, whether it is bonds or real estate or anything, if the reason for investing is sound, more often than not, the result will also be very sound. For instance, if you are investing into gold for a portfolio diversification, for hedging your portfolio, or you want to tide over the uncertainty through a security, or you don't want credit risk in your portfolio, if that is the motivation for investing into gold, then probably it's the right reason. Obviously, whatever I'm saying is not something for you to take, go tomorrow morning, get up and do that in that market. It's just an example I'm giving, and it's not a comprehensive example. And it's based on historic, the data. It may or may not happen in the future also. That also I need to tell you. Similarly, if you're investing into crude oil, energy markets have got very strong correlation with the bond yields, inflation. If you are investing into energy markets for having some sort of an offset for likely inflation or spike in bond yields, it's a good motivation. You're investing into silver market because you believe in the solar story, not a bad point to do, not a bad thing to do. Similarly, for copper and nickel, copper has got very strong correlation with the global economic growth. So if you're looking to invest into copper to participate in what you feel is going to be a very strong rebound in the global economy, that's also one thing. And in case of nickel, if you believe in the electric vehicles story that 20, 30 years down the line, the bulk of the vehicles on the road will be electric, and there's not enough nickel around to cater to it. So it's a proxy for EVs. Even copper also. Just to give, I leave you with just one data that today the consumption of copper in an electric vehicle is 6 times that of a conventional internal combustion car. So, you have a reason. Obviously, having a sound reason will not guarantee you a sound return, but then you are in a win-win situation.
Niharika,
If you invest into any asset class, with the right reason, with a sound reason, then either you will make money, which is a win, or at least you will have a very genuine learning and a lesson which will make you a better investor, better fund manager, or whatever as the case may be. Last and not but the least, every large country believes in maintaining strategic reserves of each commodity, whether it is China, US, Canada. Everybody has got strategic reserves. Now, we are unfortunately a capital and a commodity deficit country. While we have a lot of zinc, bauxite, we have a lot of iron and coal, but we don't have too much of
Yeah.
oil. We hardly have any gold. We hardly have any silver. So I think this process, which has been started now, of the pooled investments coming into commodities, I think one of the things which may happen is that investors will be able to offset themselves, or the economy will be able to offset itself through the markets against any supply shock in let's say oil or gold or nickel or whatever it is. This is some of the reasons why it's obviously it's not a comprehensive list. It is just an indication. It's not an advice, but you should know why you're investing into commodities and then only get into it. Even for an arbitrage strategy, you should appreciate anything which is giving you more than FD returns or giving you more than bond yields. What are the downside, upside risks? So it takes a while of experience and patience to address any asset class which you don't have any experience about. So I would suggest that same should be followed for commodities. So that's my take on it, Rishi.
Thanks, Vikram. That was crisp and yet very comprehensive. As you said, that commodities can offer you whatever you want in terms of views. For example, if you are thinking about the global scenario where there is geopolitical tensions, etc., then you can look at bullion. When you're looking at economic recovery, you can look at various metals. When you're looking at electric cars, you can look at nickel. If you're looking at overall economy booming, then you can look at energy products. So commodities basically give you a chance to have an exposure on either side. Having said that, just a caveat, everyone should invest in commodities or in any market for that with due knowledge and with the due study. So please, every market has the risks as well as the rewards. So just don't go by the rewards. Also, don't get scared by the risks. Study both, take a measured view, and then enter every market. Every market can be beneficial if you approach it with knowledge, and can be fatal if you approach it without knowledge. Aurobindo, now coming to you, do you have any opening points, and would you like to say how commodities will help in portfolio diversification, given the fact that you are the first mutual fund to get off the block with launching a fund which trades in commodities? So, Aurobindo, we'd like to hear from you.
Yeah, thank you, Rishi, and good evening to everyone. And it was nice. Both the participants have spoken very well, detail about having commodities into the portfolio, its advantage, and how it makes sense to have it in the portfolio. Yeah, I'm happy to say that we are the first mutual fund to have commodities in one of the schemes where with equity, debt, and commodities has been inclusion.
Aurobindo, can you switch on your video, please, if that's not a problem?
Uh, well, so it is interesting to have in the industry first mutual fund to have commodities in the portfolio, and it's been 3 months, and my sayings here are my practical experiences. I think 3 months have been really good. The first important learning that I have actually seen in last 3 months is that it actually helps to make a portfolio diversification when you have more number of asset class. I'm sure we have seen in last 3 months when the lockdown is in progress, we have seen many other asset classes have been dwindling, many other asset classes have been very volatile. No doubt commodities also have been volatile. So, especially about this particular fund, if I would say where we have commodities, we have equities, and we have debt, we have seen mixed performance in all the across asset classes. So, I would say that if commodities were not there part of that particular mutual fund scheme, then perhaps the return on that particular scheme would have been different. And when we have commodities in the scheme, then I think the returns are enhanced and better. So first learning in last 3 months that I would say is that having commodities into the fund actually makes sense to have a portfolio diversification. That is the first learning. Second, I would say that we typically say that gold as a commodity helps in terms of safeguarding the inflation. Yes, that's the fact. But today's scenario, there is nothing to talk about inflation. Rather, we are talking about recessionary stories. We are seeing commodities like energy products, they have been declining, industrial metals have been declining, some of the agriculture commodities have declined. Gold, silver prices have done well in this last 3, 4 months. So in this scenario, our portfolio managers gets into flowing into bullion trades, while one becomes very cautious in seeing industrial metals being vulnerable. But yes, when economy starts reviving, then one has lot of choices. Not only gold, silver, it has choices like metals, it has choices like energy products, it also has choices like agriculture commodities. So broadly, if I would say, having commodities into a portfolio in any of the mutual fund schemes that are allowed today in India, I think that makes more sense to have a portfolio diversification. That is going to be my major focus to look at it. I think the experience has been good, and we look forward to have more participation of commodities into the fund. That's what I would say at this moment.
Thanks, Aurobindo. Thanks for sharing your experience. And it is indeed a pleasure to see the mutual funds coming into the commodities markets and actively participating on the MCX platform. We hope to see more and more funds come and participate on the commodity exchanges, not only MCX, all the commodity exchanges, and see more and more investors taking this route, as Aurobindo said, for due to the economic uncertainty, while bullion has done well, other base metals have gone down. So, for an investor who maybe does not have enough time or the ability to study so much, then ideally, then they could also look at entrusting the money to a professional fund manager who will do the research for them and invest in a structured manner so that they can get better returns. Now, Anil, coming back to you, uh, uh, you've seen in today's uncertain times, and we've been discussing this. How important is gold in someone's portfolio? And what percentage should one have in his portfolio allocated to gold?
Sure. See, I think gold as a asset class within commodities, I think, is a very unique commodity. And as I think Vikram mentioned, gold, like other commodities, it has no coupon. So in situations where you feel that the real rates, what I mean by real rates is the actual rate of interest you get minus the inflation. So wherever you see real rates are negative, so in such situation, gold, which is also having a no coupon, but it's not negative, so gold becomes typically very attractive and it tends to outperform because it creates a kind of a positive carry. So what we have seen that historically in this type of time scenarios where one is expecting real rates to be negative, at that point of time, gold becomes extremely favorable to hold in your portfolio. Other aspect to hold gold is also that it's a kind of a safe haven, and hence it's in this type of volatile market environment, gold is very efficient as a portfolio diversification and can get good positive upside. So again, now, uh, after the fall down in some of the numbers, few of the countries are starting the, including some of the large economies like India, even larger developed markets like US have started reopening. But suddenly now last week again the new buzzword has started is like a whether there will be a kind of a renewed spike or second wave that has become like very commonly spoken about. So how I feel is that after this opening, when currently all the cyclicals and all have suddenly started rallying, like the month of April, we saw a significant rally, like everything across the world, all equity markets, all risk assets saw a very sharp rally. Whether US equities, Indian equities, all Asian markets. May month was a little bit mixed bag. Only certain things were rising. Now going forward, if we feel this second wave was to hit, or in some form or fashion, we see a kind of a spike in numbers, and this entire cyclical trade will collapse. Equities as well as the other risk assets will see a significant decline. We will see sudden in this type of situations rally in the gold prices, because one can expect that if this type of situation were to occur, then we would see more monetary policy action and more money being coming into the system through monetary policy stimulus, which will be positive for the gold. So I feel that in the current market scenario, in a so-called tactical allocation, gold becomes very, very crucial. And what I discussed earlier, that in general, not even tactical, but as a structural allocation in the portfolio also, gold is very important, very crucial, because like today's situation, gold helps in diversifying your portfolio or creating a hedge for the tail risk. Tail risk, just to put it in simple words, is like a risk of a very uncertain or a very rare sort of event occurring, like for probably what we are seeing today, or in fancy terms, what people call as black swan events or gray rhino events, something like that. So if one were to try and hedge against those type of very extreme scenarios where there is a tail risk or a rare event, where your other asset classes like equities, bonds, credit portfolios, etc., would go for a toss. At that time, the gold prices would surely be in an increasing trend, so it acts as a good portfolio allocation. So to summarize, gold is very crucial both for this type of current scenario like a tactical allocation as well as for from a structural allocation, and it can be in any form, whether it's in the form of a buying of a gold through the derivatives exchange like the MCX, or in a structural manner, because if you want to hold it for a long term, best is to buy it through a mutual fund, like how Vikram mentioned, like just own a, let's say, gold ETF, put it in your portfolio from a long term perspective, or you can also invest into mutual funds which buy into gold mining companies, shares of gold mining companies. Like, for example, we have a fund which we had launched in India in 2007, which invests in gold mining companies. Little bit different in terms of allocation because, as I think Rishi mentioned in the beginning, the equity risk comes in. So if you want a pure type of a gold allocation, then best is to have a ETF which invests into gold or the exchange traded gold on the MCX.
Thanks, Anil. So just to summarize for you all that there are various ways of investing in gold. First of all, what mutual fund explains is that if you are bullish on the economy, you can look at energy products or base metal products. If you are wanting to hedge yourself against uncertainties, you can look at gold and silver. Just for our investors, you can invest in gold in various ways. First is that you can buy it on the exchanges in terms of futures and options, and you can take delivery or take both in physical form and demat form. Otherwise, you can buy it from your neighborhood jewelry shop. You can buy the sovereign gold bonds issued by the government. You can buy the gold ETFs issued by the mutual funds. So there are various ways one can invest in gold. Now, Vikram, coming to you, you are running in Nippon, you're running gold ETF, one of the oldest gold ETFs. So what is your view on gold ETFs? You've been seeing after many years of lull, you've been seeing continued inflows into the gold ETFs across the industry. So what is your view on mutual fund participation in and the gold ETF participation on commodity exchanges? Given
Rishi,
that SEBI has allowed you to invest up to 50% of your corpus in commodity derivatives.
right. So I think, Rishi, I'll spend a few minutes on to say that why we have seen historic, past few months, the kind of flows we have seen in gold ETF have been at all-time high. And it's not us, it's the entire industry and the entire world. In fact, if you compare ourselves with the world, we are nowhere in terms of the kind of flow that the world is seeing. Globally or locally, the flows are at all-time historic highs. So I'll just spend a few minutes on why this is happening. And there are 3-4 reasons why people are betting on gold or people want to hang on to gold. First of all, it's like, every time we want to hold any security or any asset class in our portfolio, we do a analysis or a checklist. So I'll do a very quick checklist and analysis on gold and why people want to go for gold right now. First of all, is a track record. Whether it is a 50-year track record of gold or whether it is 20-year track record of gold, gold is given on a long-term basis anywhere between 8 to 10%. Obviously, the 3-year returns and 2-year returns are just amazing. So I don't want to. Obviously, 3-year return is close to 15, and 5-year return is close to 10, 11%. And even our funds, which were started about 13, 14 years back, they have given return in excess of 10 to 11% on an annualized basis. There's a very formidable track record of gold, which is very difficult to argue against and ignore. Secondly, in terms of liquidity, now all of you must have seen that in the month of March, while the equity markets were hitting lower circuits, no, gold was volatile, but you could buy and sell gold. And in terms of liquidity, gold is as liquid as maybe any large, equity index like Dow or S&P 500 or Nifty, or any short-term currency treasury series. So that's saying a lot about the liquidity of gold. And gold is the only one of the very few asset classes which you can trade outside the exchange anywhere in the world without too much of a material deterioration in the value of gold. But again, the other aspect is the safety and security aspect. Now, safety and security aspect is that whenever there is a stress in the credit markets, the funds and the central banks like to hold gold because gold doesn't have any credit risk. So, and you have to appreciate that today, even after so many years, gold is the only physical asset which the central banks hold. And that is entirely because of the liquidity and entirely because of the safety and security. So, I think if they have picked gold in terms of safety, security, and liquidity, I don't think we should have a problem investing in gold. But I think there's one more thing which I would like to say, which I realized was not available. Gold is also can be a leading indicator of the markets, whether it was 2001, whether it was 2008, or whether it was 2020. In all the three instances, gold bottomed out before the equity markets. And for instance, in 2001, gold bottomed out a few months before Dow Jones and embarked on a 6-year bull run, giving 250%. In 2008, gold bottomed out a few weeks and months before Dow, and it embarked on a 3-year bull run, giving about 170%. Even now, also, if you look in the month of March, gold bottomed out a good week, 10 days before Dow, and both, I think, are up neck to neck 20 odd percent returns since then. So, these are some of the things which have obviously, as a mutual fund professional, I have to warn you that not every crisis is same. Just because gold has performed well in crisis in the past, there's no guarantee it will do it. But I think the gold investors are convinced that every crisis is a good opportunity to buy gold. So that is the reason why you're seeing such strong flows into gold. Now, in terms of, obviously there's a lot to say on that. But I think I'll tell you one thing, Rishi. One thing which needs to be, very well appreciated, that whilst gold ETFs have not, diversified into gold derivatives, but I think there's a reason for it. Um, uh, but you have to understand that where we are as far as the acceptance of commodities are concerned in the mutual fund space. I'm pretty sure you've been doing this for a lot longer than many of us. But few years back, if you were to go and approach a mutual fund about commodities, you would have seen people falling off their chair. But today, every fund house, rather most fund houses, now agree and accept that commodities is a bona fide, viable, genuine investment opportunity. And that's saying a lot. Give credit to SEBI for opening it in a very proper manner, and also do credit to MCX for being tenacious and being at it and building track record and credibility in the market. And today nobody questions. It's like this contract MCX. So this is the kind of work we have been able to achieve. But what will also happen is, mutual funds, you have to appreciate, cater to the lowest denominated, lowest denominator who comes with a very small money in the market. Now you have to understand whenever, whether it is us or any other mutual fund, whenever they want to launch something new, which is different, you have to build a consensus in the ecosystem, whether it is your partners, your investors, or your advisors, or whatever it is. And so that takes time, but that process has begun. We as a fund house have been doing it for the past 1.5 years. And I'm very sure Anil and his team and Aurobindo and his team has also been doing it equally vigorously over the past 1.5 years. So there is a consensus building which is happening. Bit of an issue because since gold has become such a hot commodity right now, that the kind of flows we are getting in, So perhaps maybe derivatives is not a priority right now. But I think once the as Aurobindo mentioned, once the multi-asset funds, number of them increase, once the fund houses get experience, the comfort, the back-end, front-end experience on the derivatives, the advantages, how, I mean, it's very, very clear. An MCS contract will always be more liquid than physical gold bar. So that goes without saying. Once that happens, or we have a situation when some other commodity fund is launched, like a silver ETF or whatever, where the fund houses can go to the drawing board and start and have experience and feel of the commodity derivatives. So it's just a matter of time. Maybe it has been put off back by a few months because of the COVID crisis, but I won't be surprised by end of this year we'll have lot many fund houses doing multi assets, doing derivatives and gold ETFs. So it's just a matter of time, Rishi. We need to be patient.
Thanks, Vikram. And due to the COVID lockdown, I am sure that many fund houses' plans have got delayed or delayed. On the point of gold, that yes, with more and more quantitative easing, you will see more interest in gold because money is losing its value. Now, coming to you, Aurobindo, taking forward from what Vikram has been saying, uh, both in terms of, I have three questions for you, one by one. So I'll ask them and then you can answer them at your uh, in whatever order you want. One is that how have mutual funds opened the door for retail investors? Second is that would you like to speak about the three kinds? So I'll basically mention it, and if you want, you can elaborate. That SEBI has allowed uh, uh, fund houses to invest in hybrid funds to the extent of 10%, in multi-asset funds in term to 30% of the AUM, and gold ETFs to 50% of the AUM. So would you like to explain how that fund is structured? For example, you've launched a multi-asset fund. So would you like to explain, I mean, not specific to your fund, but what is a multi-asset fund for the benefit of the audience? And third is, what is the growing importance of research in terms of investing in commodities? Because unlike equities, which are wealth creation tools, commodities are more of mean reverting tools, which can give very good cyclical returns and also act as inflation hedges. So, Aurobindo, all three questions for you.
Yeah, yeah, Rishi, I think I'll try explaining or answering to some of the questions that I can. Let me first talk about the regulation point of view, what SEBI has allowed. I'm sure it's been a year now, the SEBI has come up with the regulation that mutual funds can participate into commodities. And it has been very, very clearly stated that it is only allowed under
Aurobindo, can you
hybrid
start your
scheme.
video, please?
Yeah, well, I did not start my video. I thought the
No, no,
internet
no.
bandwidth might come down. Well, so it's been very clear that commodities are allowed only under hybrid scheme. And since you mentioned about any sort of hybrid schemes where commodities are allowed up to 10%, however, pertaining to multi-asset particular category where commodities are allowed up to 30%. I think I would like to reiterate a minute about our fund where multi-asset has commodities inclusion in there. And since it is being an equity taxation scheme where we need to have equity exposure up to 65%. So we have that, and three asset classes are minimum mandatory, that is equities, debt, and commodities. So in our fund, I would say 65% goes into equity, 10% goes into debt products, and 25% which is left out is on commodities. So our fund is structured in that manner. So I'm sure I would like to talk about here. One point is that, of course, multi-asset as a category has been there in the industry for more than a decade. And we being the first in the industry, that the third asset class is not only just gold, it's beyond gold, and we have more other commodities which is being offered today by the Indian commodity exchanges. So why should one have only gold, or one should have gold plus other commodities? Is that I'm sure we spoke a detailed about portfolio diversification. We spoke about when inflationary concerns are there, gold price goes up. When recessionary concerns are there, other commodities goes down. When economy does well, the other commodity also does well. So within commodity as an asset class, sheer dependence only on gold, or you have more number of commodities to participate, is actually a comparison to make. So I think we felt that under a multi-asset scheme, since SEBI has permitted to have more number of commodities within the commodity section, it is always good to have gold plus other commodities. So I think it makes more sense to have diversified commodities within the sector of commodities along with equities and debt. So I think up to 25% seems to be very, very minimal percentage of allocation that is being allowed today by the regulator. I think to begin with, that seems okay. But then I think going forward, I would always want the industry to look forward to have more percentage of allocations of commodities into the fund. And part of the other hybrid schemes, like if we look at it beyond, besides the multi-asset, of course, today's date only 10% allocation of commodities are allowed. I think that is something that one should look at it, because I believe very soon maybe other mutual fund houses are going to come up with their own schemes where commodities allocation up to 10% within the hybrid schemes can be allocated. So I think the 10% initially to taste looks better, but then I don't want to have a limit of 10% only. Rather, I would like to have more percentage of allocation into the commodities so that it gives a better alpha into the fund, uh, plus a better risk management of beta. So that is what I would say. The second question that I tried understanding about the research. Yeah, of course, I myself have been into commodity research for so many years, and I understood the importance of having commodities research when you are especially participating your investors, retail investors' money through a mutual fund scheme. It's very, very important to have a very detailed and structured research. So I think research is very important in commodities as a sector. Like Vikram was talking, and Anil was also talking about smart commodities being cyclical in nature. Yes, they are cyclical in nature. They are unlike equity markets or any other asset classes that we just have to buy and hold. Here in commodities, we have seen both uptrend and downtrend during a year. So I think one needs to be very tactically comprehensive about selecting a particular sector or a particular commodity while investing into commodities within the fund. So research needs to be very, very strong in the entire industry fraternity. I myself have to do enough of research in selecting a commodities. Plus, today in the industry, the sell side research also needs to be very, very strong while facilitating the services to the mutual fund participants in the country. So these are the two points that I wanted to talk about here. Rishi, did I miss out on something that you wanted me to answer?
No, that's fine. I will come back quickly to Anil. Anil, just a question: how do you see retail investors accessing commodities? Because retail investors uh, who who do not want to have exposure to futures and options, but want a pure investment product. How do you think mutual funds would act as a vehicle for them to access these markets? That is the first question to you. And secondly, what is the size of the market you see? Because the mutual fund industry has been growing by leaps and bounds. And given the 10% and 30% allocation and the 50% to gold ETFs, we did a back of envelope calculation and we saw that around 39,000 crores of funds could flow into mutual funds potentially, which we did around 6 months back. And so, given this, so how do you see this panning out over the next 2 to 3 years?
Sure, Rishi, you see, the first question about how retail investors can participate, I think you said very perfectly that the mutual fund is the most simplest and easiest route to take, because though there are a lot of products available directly also, like you mentioned, on your exchange, as well as if you know whether it can be through a derivative through, or it can even be physical, but that is only for certain commodities. Like if you want a basket of commodities, like let's say gold, silver, some base metals, like a combination or something, it's virtually not possible to do it directly. And also then, as we just spoke about it, that retail investors then don't have the wherewithal also to get a grip on the commodity movement and how to go about tracking it. So from that perspective, I think the simplest way would be to enter via mutual funds. And currently, SEBI has also done a very prudent approach, wherein they are permitting certain small component of the entire scheme to be investing into commodities. So, like for example, what Aurobindo mentioned about in their product, or some other funds where it is enabled to invest up to only certain percent into commodities. So those would be the easiest go-to products for retail investors to get access to commodities. Because otherwise, I feel the Second easy option is for somebody who can take a specific individual commodity related view and wants to hold it. Then yes, there is always the gold ETF available. Unfortunately, at least at this point of time, no other ETFs are there which give single commodity exposure. But by far, gold ETF, I mean, gold as a commodity in investor asset class is a very good allocation. So one can access through that route. What you mentioned about how you see or how we see how big the mutual funds flows into the commodity derivatives can start. I think you mentioned a very correct number. Even that's what back of the envelope number I had in mind. Roughly about 40 to 50,000 crore of so-called potential allocation into commodities can happen. Assume all these hybrid portfolios existing currently were to take the route which SEBI enables to go up to the maximum allocation into commodities. Now, my view is that it will take little time because for all of those funds to start doing investment into commodities and then going into that full percentage, it will be little bit time. But in parallel, we could see a whole lot of other funds being launched, like what Aurobindo mentioned, that there is a new fund which they launched, which was a multi-asset fund. So now that has become a very important flavor, that people want to have one product which will have a good mix of equity, bonds, as well as commodities, in such a form and fashion whereby it can deliver a slightly better return as compared to, let's say, a short duration fund or a medium duration fund with a much more balanced volatility. So I feel that these type of products can be taken to even fresh set of mutual fund investors, and they can start getting onboarded, including investors who are new to mutual funds. So it can even help in kind of enhanced penetration strategy for mutual funds as a particular product range by creating this type of awareness that yes, commodities is a good allocation to your portfolio. And look, I'm giving you one simple to understand, easy, transparent asset allocation, which will have equity, fixed income, and currency. So those I think will be in fact faster and can become much larger very soon.
So thank you for that, Anil. I hope very soon we will not only see mutual funds sahi hai, but mutual fund mein commodity bhi sahi hai. So
Absolutely.
hope to see that very soon. And I can understand the predicament of the industry that for existing schemes, changing the scheme parameters to include commodities may not be that practical. But new schemes coming in and having more commodities investments could be the way forward. Now, Vikram, coming quickly to you since we are running short of time, a couple of questions. Now that indices are coming, what do you see the interest from mutual funds and indices? And also the second question is, what would be your view on the allocation? Not only we talked a lot about gold, but what about base metals and energy to a multi-asset portfolio?
Okay. Yeah, I mean, I'll before I answer your question, I'll just spend 10 seconds on what Aurobindo and Anil said, and I think they've articulated it very excellently how it is to be done. But I think I'll just share one data point with you that today the bullion market in India, gold and silver put together, is about 3 to 4 lakh crores, all put together, physical derivative and all put together. And out of that, as per the World Gold Council, 10 to 20% of that goes into investment into physical bars. Now you're talking about not 30, 40,000 crore, but somewhere around 60 to 80,000 crores worth of potential in just two commodities per year. So you can imagine where we have started and what is the upside over here. But obviously, it will take time. I'm not saying it's going to happen tomorrow, but yeah, that's the kind of the numbers that we should be talking of right now. Now, in terms of indices, I think they're extremely important from the investment point of view. First of all, it solves sort of a very important the parameter which is very important for a mutual fund is that it is an aggregation of it's an aggregation of so many things involved in it. Now, obviously, we have seen some indices coming. Obviously, you have maybe a bullion index or the Comdex, or there'll be other bullion indices are coming. But they will have a purpose to solve. Can they be a proxy for, let us say, the economy? Can they be a proxy for inflation? Can they be a proxy for demand, or can they be a proxy for participating in the metal story? So these kind of things will actually drive the demand of the indices. It has to be thematic. We have to have a theme on why the investors should look at the indices. The good part is that the indices are all cash settled, and it makes the operational aspect very, very easier for the mutual funds. Also, I think perhaps, as I understand, the indices in some way reflect the demand supply, realities or the local realities also. So, whilst the commodities included are all international, like copper is international, gold is international, silver is international, but it has a semblance of it's mirroring the demand supply or the market situation. So it becomes an excellent proxy for the entire sector. If you want to whatever is the theme, whether it is the global growth or the local growth or local consumption, those themes become extremely important for a mutual fund. So that is where I think I see a very, very good future for commodity indices, and it's just a matter of time it becomes a must-have in most portfolios. Sorry, what was the other question, Rishi, you asked?
The question was just quickly, how would you summarize the importance of? So we've talked a lot about gold and silver, but how would you highlight the importance of bullion and energy products? Base metal and energy products in a portfolio, or for that matter, agri products.
So yeah, so I'll answer it in 2 3 lines. We have, as I mentioned, we have abundance of zinc and bauxite. So obviously, you are better off investing in Hindustan Zinc or a Nalco or a Hindalco. But we don't have too much of oil. If you want to invest in a bona fide oil primary producer of oil or gold or silver or nickel, there isn't. Nobody is there today. So how do you do that? The best way is to participate directly into the commodities. Whilst the commodities will have a slight difference in its cycle vis-a-vis the underlying, the stock. But I think what you have to also remember that when you're buying into commodities, whilst the leverage may be less, but you are taking care of the credit risk, the management risk, and so many risks. So there are pros and cons. There will be times that it will make sense to invest into the stocks of commodities, and there will be times it will make a lot of sense to invest into, the commodities directly. So yeah, so Rishi, I have taken very
Thank you.
little time.
Thank you. Aurobindo, one last quick question to you. SEBI has been very kind and been very eager to help mutual funds and institutional participants into this market. And recently, SEBI has allowed mutual funds to hold the commodities, especially the bullion, for more than 30 days, as was the earlier norm. And given that the returns from arbitrage funds have been attracting a lot of inflows in the recent past, but given that the returns from the equity arbitrage funds are falling, and commodities normally give a very decent arbitrage return. So what is your view on mutual funds participation or launching of arbitrage funds and participating in the commodities markets for the cash carry arbitrage?
I'm afraid I don't know how to answer this point, but that sounds a little tricky. But I would try to give my thought process on this. Let SEBI decides whether the full-fledged arbitrage fund of commodities should be allowed or not. But if it is there, then definitely not only me, I think the entire commodity fraternity will be happy to have it. And coming to the point of regulation that SEBI recently came up, extending the time frame of holding gold, silver more than 30 days is definitely a welcoming move, because 30 days has been really constrained for anybody to participate into gold, silver. And we, of course, understand that gold, silver trades in Indian commodity exchanges are of 2 month contracts. So by any means, we would not have been able to participate because of 30-day restriction. So this 30-day has now moved to 6 months. That definitely attractive move for a portfolio manager to look at it, and he has a better bandwidth to spend on that. And yes, I would say it has now been only allowed for gold and silver, but then it would have been much, much better if this 30-day extension would have been given to other commodities as well, at least for the other metal sectors. Then probably it would have been a much fair play for mutual fund player as well as non-mutual fund players, because rolling over of trades are not allowed in other metals or energy at this moment. So I think Well, it is fair to have commodities in the portfolio, and separately exclusive arbitrage fund should be allowed or not. I am something that can't comment here. However, I would always like to have commodities being part of the equity arbitrage fund in the schemes that are there in the industry. Then probably we understand that commodity arbitrage fund typically gives a decent return over the FD returns or maybe equity arbitrage return. So if commodity arbitrages are allowed into the equity arbitrage return, then I'm sure the entire portfolio will see a enhanced return in the fund. So these are the few points that I would like to say here at this moment.
Yeah, Aurobindo. So I would like to clarify that what I meant was that allowing commodities to be part of the overall arbitrage funds, not having arbitrage funds separately. Of course, as and when the regulator deems that fit, we would welcome that. But basically my idea is that the regulator also wants to take one step at a time and test the market, see that everything goes fine, and then allow more and more things. So as we are going on, it is natural that we will always will mange more, so we'll wish for more and more. But we have to prove ourselves, we have to deliver. As fund managers, you have to deliver, as exchanges, we have to deliver. All of us have to prove ourselves to the regulator that we can handle the responsibility being entrusted on us very well. And once we prove that, I'm sure that the regulator will give us more and more to deal with. It has been very.
I just like to make one point because you mentioned about derivatives usage and arbitrage as well as some kind of hedge within an overall portfolio. So I feel one more very important utility, which in some ways also already enabled from regulatory perspective, is that in a mutual fund portfolio, which is comprising predominantly of equity shares, okay, there also in certain elements having commodity derivative can be useful for some hedge. I'll take one simple example. Let's say in a particular stock portfolio, without taking any stock names, let's say it's a rice producing listed company. There are some, which is manufacturing and selling and distributing rice. Now, suppose the stock is good, company is stable, good management. So the fund manager wants to hold it for a long-term perspective. But let's say in the near term, let's say 2-3 months, one quarter, the crops are not very positive, and that there is expectation of price decline or something of that sort. So in that scenario, if there can be a utility by way of, let's say, hedging a particular commodities future, whereas continuing to hold the stock in a long basis. So these are the different type of utilities also which will start gradually coming up, and the utility of the commodity derivatives will enhance.
Very, very good point, Anil. Thank you for that. So that's another
Rishi,
aspect.
Rishi,
Yes.
one point I'd like to make in a lighter vein. Unfortunately, MCX in a more or less like a monopolistic situation in the commodities it is there, but the mutual funds are not nowhere even close to monopoly. So what you said was right
But why
that
is it
whilst
MCX as a monopoly?
so whilst you are right, but I think today, thanks to the IT enabled infrastructure, it takes just double 2 clicks for the investor to redeem a fund. So we understand that if fund managers don't do a good job, we are just 2 clicks away from redemption. So yeah, so it's an opportunity, but it's also a responsibility for us to ensure that the lesser the bumps, the better it is for all of us.
Yeah. So I remember this dialogue in Spider-Man: with great uh, power comes great responsibility, right?
Yes,
So,
absolutely.
so the more we get, the more we need to
Good
give.
point. Yeah, good point.
Yeah. So thank you, gentlemen. It's been very enlightening. I'm sorry we are running way ahead of time, but I would not like to disappoint our viewers. So quickly, if we can have some questions, you can type your questions in the chat box, and I can and also mention who is it for, and I will address it to that participant. So the first question is, Vikram, can you explain the reason why gold ETFs are not diversified in the Indian derivative segment? I think you've already answered that, so we'll bypass that. The next question is, commodities are cyclical in nature. We have seen gold cycle last for, say, 3 to 4 years. So let's say from 2021, you assume gold will start its downward cycle. Then how will mutual funds take care of the same? I'm sorry, I will not ask my panelists to answer this because we do not want to give any forward-looking statements since this is an investor protection fund program. The next question is, how are trading platforms and trading management important compared to global market in India in terms of technology and digital transformation? Who would like to take that?
So if you want, I can take the.
Yes, yes.
So, I think you have to understand the landscape of the market today. Today, whether it is a commodity exchange or an equity exchange, the 80 to 90% of the short-term turnover is all done is machine driven. And these machines are, backed by people who have invested their lives and, people who have invested millions and billions of dollars on the hardware and software to do it. So it's very important to understand where obviously we need short-term trading and speculators to increase. Speculation is the grease of every market. But I think you need to appreciate one thing that, I want to share a humbling statistics with you that, if you are an untrained trader or somebody who cannot, doesn't have a armed with a good software today, then it is akin to you just getting up one day and planning to play Wimbledon against Roger Federer. So that is the kind of difference which has come up in the markets. You got to be very careful. Obviously, if you're good at short-term trading and if you're making money, then probably pat yourself that you are of Olympic grade. But that is what technology and trading has done. It's all, if not 100%, I think 80 to 90% in every exchange is mechanized. So that is what it has done. But what it has done for the long term, this thing of the markets, it's not very clear whether they have added volatility or whether they have added more revenue, more people dependent upon that. That is something that still remains to be seen. But yeah, short term, all the liquidity, thanks the machine.
Okay. And the next question is, how many custodians do we have in commodities? That's for me. So at present, we have 3 custodians who have been allowed in commodities, and hopefully going forward, we'll have many more. The next question is, will mutual funds be interested in options on goods in gold? Who'd like to take that?
If you want, I can take
Yes,
that one
yes.
with permission of Anil and Aurobindo.
Yeah, please.
Yes, sir. Please.
Yeah, go ahead.
Okay. So, yeah. Aurobindo, you want to take it?
No, you
Okay, I'll take it. Okay.
Go ahead.
All right. Okay. So you're talking about option on goods. Now, they're slightly different than the option on the futures. And the way, I'll just give you an example. So, for instance, a lot of us forget that, we are one of the largest consumers of gold and silver in the world. Let's just stick to gold and silver right now. Now, obviously, gold has got a lot of intraday volatility, and you can imagine if you're a jeweler or if you're a retailer who has, obviously, it seems gold may have a lot of margin, but gold has got wafer thin margins in each layer. So that is why, for people who have smaller scales or who have exposure to the physical market, it is a very, very important tool for them, because when you buy an option, your cost is limited, and so is your downside, whether it is a call option or a put option. So that really helps. It's going to be a very, very big enabling tool for the trade, not so much for the investment community or for the trading community, except it can be used for good arbitraging and for risk management. But I think it's a very, very important move. See, we have to appreciate mutual funds have only appeared recently. Most of the volume which you're seeing on MCX, and which is quite grand, already is generated by the trade and the traders, if you want to like to call them. So I think it's a very, very good move.
Thanks, Vikram. So basically, I'd like to say that in most markets, when they start, it is the institutional participants who come in first, and then retail and corporates and hedgers come in. Historically, however, commodity markets, due to various reasons, have had corporates and individuals and traders being allowed, retail traders being allowed, but it is only now that we are seeing the institutional participants. So it's like you have an inverted curve, inverted yield curve. Similarly, we have an inverted participation curve in commodities, but I hope it will get corrected soon. Like an yield curve also doesn't stay inverted very long. It gets corrected very soon. So hopefully we'll also see the institutional participants adding a lot of depth, because there's always been a latent supply from hedgers on the sell side, but there hasn't been long-term money on the buy side in commodities, and that is why the liquidity and depth of these markets have been limited. But now, since the buy side is coming in very strongly through mutual funds and other institutional participants, I'm sure that the sell side latent supply will be met and the market will become more vibrant. With that, I'd like to thank everyone all our panelists for gracing us with their presence and with their wisdom. And thank you all so much, Vikram, Aurobindo, and Anil. And thank you for being with us, and look forward to having you again on another session very soon. Thank you, participants, for listening so patiently and being with us today. It's been indeed a pleasure. We hope to organize many such more programs for investor awareness and for your benefit. Thank you so much. And before you leave, kindly give your views in the chat as to how you like the program. Thank you all, and have a good day, and take care of yourselves. Be safe. Keep your families safe in the COVID. Maintain social distancing so that we can see each other physically at the end of this pandemic. Thank you so much, and good day.
Thank you very much, Rishi.
Thank you.
Request you to please provide your feedback. This is required for a compliance purpose. As we are doing this event under MCF IPF banner, there are some requirements which we need to comply with. My colleague Pratik has posted some queries, some questions. Please give your response to him. So he has posted, how was the introduction to the topic? How will you rate it? Average, good, or excellent? Please provide your feedback. Pratik, you can also post second question. Pratik? Pratik, can you hear me?
उसमें डाल दो चैट बॉक्स में नजीर।
हाँ सर, सेकंड क्वेश्चन चाहिए। हाँ,
ये 100 का था लिमिट क्या है?
हाँ सर, इसमें आज है ना, बट 113 people participated.
बट वही बात है बॉस, आई एम गेटिंग मैसेजेस अनेबल टू लॉग इन अनेबल।
सर, I have to 13
ठीक है,
of
बाद में
this from
बात कर
people.
लेंगे।
Yeah. Pratik, can you please pose the second question, please? Pratik, you are there? So thank you all. Thank you for participating. We look forward for your participation in all our subsequent webinars. Thanks a lot.
Yes, thanks to all.
Sir, end करते हैं session.
हाँ ठीक, एग्जिट हो गए ना सब लोग?
जी सर, कर दें end?
हाँ हाँ
ठीक है सर, okay.